we're seeing flows in a lot of different areas, actually. We're seeing flows into our high yield funds, and particularly we've seen almost daily flows into our highest risk fund, lowest rated, the Triple C fund. The ticker for that is XCCC. We've also seen a lot of flows between our treasury suite of, if you know, they target duration instead of maturity. And so we're seeing investors not only continuing to like the short end with our XHLF and XONE, which are half year and 1 year ETFs, but we see them going out longer, as long as our X20 ETF.
JoAnne, I was amazed looking at the last year's performance of the Triple C rated ETF, up more than 19%. What drove that? Was it just so much pessimism entering the year about a recession and that these struggling companies, the default rate would be higher? What happened to drive that really impressive return for that very risky ETF?
Well, started the year yielding over 15% and spread over treasuries of over 1,000 over.
Wow.
And that was probably, just in hindsight, it was punished too much in 2022. And with the resilient economic conditions that we saw throughout 2023, it enabled that fund and triple C's in general to outperform. We did not have a spike in defaults last year. They increased somewhat, but not to the point where you definitely did not see recessionary conditions. And so the resilience that we saw, including companies that were rated the lowest in high yield, was actually quite refreshing.
So we're seeing mortgage rates come down along with the treasury market here. What ETFs do you have, or do you direct clients to if they want to play the mortgage-backed security market?
Well, we don't have anything in particular in the mortgage-backed security market, but our high yield ETF that it focuses on financials and REITs is probably a play on that, as you'd see rates come down.
And do you expect to see the Fed to be as aggressive as maybe the market's pricing in right now?
Probably not. I mean, our whole view, for the past year and a half has been not to fight the Fed. So, we believe them when they talk about their 2 to 3 rate cuts for next year, and we're not as optimistic as the market. The market's been overly optimistic for over a year and a half now. So.
Yeah, JoAnne, one of the bigger ETFs among your offerings is the 6-month target duration U.S. Treasury ETF, assets of more than $1 billion. I'm curious how people are using that. Is it kind of like an alternative to cash, to a money market fund? Is there an advantage to using an ETF in that fashion compared to a money market fund?
Well, yes, in that it has really low fees. The fees for that are only 3 basis points, versus money market funds are higher on average in terms of the fees that they charge. And also, it's very liquid, it's easy to use, it's yielding over 5%. So in low volatility. So there's just a lot of reasons why there's been a lot of demand for that fund.
So we saw the outperformance in high yield in 2023. Do you expect that to continue in 2024? Because, again, there's a lot of recession talk out there. We haven't seen it, but there's a lot of talk out there.
Yeah, so our base case view is that the U.S. economy will continue to remain healthy in today's higher interest rate environment. We're not forecasting a recession, even in our downside view at this point. Obviously, we're always watching for, signs that change our view, but that's what we think right now. And so that supports the high yield market around current valuations. So we're still at elevated yields, and it's basically an asset class which offers the highest coupon income you can find in U.S. public markets, either equity or fixed income, with less volatility than stocks. So we still like high yield at this point.
Is it safe to extrapolate your opinion on the economy to the idea that that 6 rate cuts that are being priced into the short-term interest rate market, is that a lot of people don't believe that's really going to happen? I'm curious what you're thinking about it.
Right. Yeah, that's not our estimate that it would be 6 rate cuts at this point.